What I think people need to do is take a moment, zoom out, look at history. So we tend to forget that in 2007, the Fed cut by 50 basis points. It was actually on the exact same day, September 18th. And what you saw at that first rate cut is CPI running at around 3.5%. And then what they did is they cut another 25. They cut another 25. And then going into 2008, they're supposed to have a meeting January 29th. They actually had an emergency meeting. January 22nd, because things got so bad, where they cut by, I believe it was 75 basis points. And then a week later, they cut by another 50 basis points. So these massive interest rate cuts. Now, during that time, what was happening as far as the narrative is people were saying that they're cutting too much. Inflation is going to reaccelerate, which oddly enough, it did.
George Gammon discusses how Federal Reserve rate cuts often signal upcoming recessions, not just inflation risks. He highlights government overspending as the root problem, likening it to an addiction that damages the economy. For commodities, he predicts long-term growth despite short-term drops, seeing these as buying opportunities. Gold, while volatile, remains a strong hedge, though it may temporarily fall during liquidity crises.
You fast forward to August of 2008, the CPI went from right around 3.5% up to 5.6%. So then if you read the Wall Street journals around that time, which I like to do, when the CPI report came out in August for July and it printed the 5.4 or 5.6, what the narrative was back then is the Fed is going to have to start hiking rates. So going into the end of the year, they've made this huge mistake. They're way off sides. They cut interest rates way too low because they're afraid of the boogeyman. The economy isn't doing that bad, even though the stock market went down. So now they've let the inflation genie out of the bottle. Now we've got to worry about not disinflation or deflation, but we've got to worry about a reacceleration of consumer price inflation because the Fed has totally lost control. And oh, by the way, the 10-year Treasury yield from that time in January 22nd to August, it went up. So they're saying, look, the Fed has lost control of the long end of the curve. And the biggest concern that we have is a reacceleration of consumer price inflation. This was August of 2008. And I'd like to remind the viewers that just 2 or 3 months later, interest rates were at zero. And you fast forward about a year and the inflation rate was -2. In other words, 2% deflation, not even just disinflation. I'm not using that example to predict and say we're going to see the exact same thing in 2025 that we saw in 2008. But what I am saying is just because we see interest rates along the curve go up after the Fed cuts, and just because we see the CPI go from 2.4 to 2.6, doesn't necessarily mean that there's a 100% probability that we have let the inflation genie out of the bottle. And then if you go back to 2001, you see that to a lesser degree, we saw the same cycle, that once the Fed cuts rates, the 10-year Treasury yield actually goes up. It doesn't usually go down for quite some time. But then what happens is what the yield curve is predicting, that usually over the next year or year and a half plays out once the Fed starts cutting rates. You know, when you look at the yield curve, the crash or the recession or whatever you want to call it, the hard landing, it rarely occurs when the curve is actually inverted. It usually occurs after the Fed starts dropping rates, and that's what makes the curve steepen out and uninvert, and that's when the stuff usually hits the fan. Usually. Now, it could be different this time, but what I like to do is just go back and look at these cycles, going back to the 1950s, and say, okay, 95% of the time, let's say it plays out this way. The end game, if you just fast forward a year or two, is very rarely a reacceleration of consumer prices. It's usually disinflation. That's then followed by an acceleration of inflation due to the response mechanism from the central planners. So that's my base case right now, and that's just based on what has happened over the past cycles. Well, I think what you have to ask is, why did they cut in the first place? Like, why did they cut 50 basis points? It's not because the economy is booming. And I get it. They're no more focused on unemployment as opposed to inflation. But they're doing that because growth and inflation expectations are declining. You know, you look at the SOM roll. That's a great indicator as to just that in and of itself. You know, look, when you see that go up by 50 basis points or whatever it is, you know, you're usually very close to, if not in a recession. So it's not just that. If that was just the only indicator that we had, you look at the inversion of the curve, you look at all these other things. I mean, nobody would sit there and say that the poor and middle class is doing well right now. So then it becomes, well, why is the upper class Why are they doing well? Well, it's because of asset prices. Okay, so what you're telling me is the entire U.S. economy is built on asset bubbles. And yes, those bubbles may be able to continue into the future, but they can't continue indefinitely into the future, right? So then you have to say, okay, what is the pin that's going to prick that bubble to where it'll impact the aggregate demand of those people at the top to where they join the poor and middle class, and then that's usually when you see a recession. It doesn't mean you have an absolute crash like the GFC or during COVID or something like that, but you just see a balance sheet recession that may be very similar to what we saw in 2001. But oh, by the way, the Fed dropped by 50 basis points to start that interest rate cycle as well. I don't think we have a debt problem is because we look at interest rates right now and we've got the 10-year trading under Fed funds still, even though the 10-year has gone up. If we had a debt problem, that would be reflected in interest rates. If Fed funds is at 4.5%, and we had a debt problem, meaning that we've got all this supply that's coming on, we have all this demand that's deteriorating because all these foreigners are dumping treasuries, and they look at the off-balance sheet liabilities, whatever. They say there's no way I want to hold treasuries anymore. The interest rate on the 10-year would not be under Fed funds. Right. It would be 8%. It would be 9%. So since you have an inverted yield curve, that in and of itself tells you that there's massive demand for treasuries. Just look at the price. Don't take my word on it. So let me give you a quick example. Let's say you're a bank in the Cayman Islands, and on the liability side of your balance sheet, so your dollar funding, you're paying 2%, right? And let's just assume that you can match up the maturity with your deposits with a treasury. So let's say that you have a time deposit of 2 years, and that's $10 billion, and you're paying 2% for those dollars. How many treasuries would you buy? The answer is limitless, because your dollar funding costs are 2%, but yet you can get, let's just say 4% on that treasury. You're pocketing the 2%. You don't care how many 2-year treasuries Janet Yellen issues, because you're going to buy more. And what happens is if the interest rates go up because of supply, you're just going to buy more that will bring them back down to the fundamentals as to what moves rates at the long end, which is those growth and inflation expectations. Because if you think that growth and inflation is going to be higher, then you're going to take that balance sheet capacity and you're going to allocate it to lending into the real economy as opposed to buying the treasuries. And then interest rates go up because of that inverse correlation between price and the rates themselves. So my point is, I don't think we have a debt problem. But the problem is the spending. Well, it is sustainable, unfortunately. The problem with the debt crisis is there's no debt crisis. Because if we did have a debt crisis, that would actually constrain government spending. The problem is we don't have a debt crisis, and there's going to be banks out there that are willing to buy this debt because of that spread, that dynamic. It's one of the dynamics that we just talked about. So this gives the government basically an unlimited credit card to sit out there and spend and spend and spend. And the problem with that government spending is that's what distorts the economy. A lot of people will sit here and say, well, my goodness gracious, if we could just get the government spending back down to 50% of GDP, well, that solves all of our problems, because then the foreigners are, with all this additional supply, there's going to be balance sheet capacity, there's going to be demand. No. That makes the problem worse. It's the example of the heroin addict that I always use. So let's say he's got a credit card, he runs it up to 100,000, injecting more and more heroin into his bloodstream that destroys his body and destroys his mind. And you say, well, the problem, obviously, is that he maxed out his credit card. So let's just go ahead and give him another credit card. Are you helping him or are you hurting him? You're hurting him, because now he's going to inject more heroin, and that's the problem. The debt isn't the problem. It's the fact that he's injecting heroin and more of it into his bloodstream and destroying himself, killing himself, right? And that's the way you have to look at the U.S. economy. It's the injection of heroin. It's the government spending. It's not just getting the debt under control to where it's 50% of GDP as opposed to some arbitrary number, let's say 125 or 120%. So going back to why I'm bullish, when we get this talk from all these influential people of reducing the size of government, that's what really gets me excited, because I know that's the real problem. So commodities, I think you have to look at it through the lens of a commodity supercycle, and then you have to look at it in a short-term basis, right? So what commodities do over the next 6 months, I don't think is really indicative of what they'll likely do over the next 10 years. So when you look at early 2000s as an example, that was the last, big commodity super cycle that we had, right? And I think that we probably were at that mark in 2020. I'll bet you 10 years later, if we look in the rearview mirror, we'll say that the bottom in commodity, or especially oil prices, was when it got to negative like $38 a barrel. It was that April of 2020. That was probably, I doubt oil's going back to negative numbers. So from there, you say, okay, it's the trend is likely up. That doesn't necessarily mean that it goes up in a straight line. Nothing ever does. So I think that you could see some downward pressure in commodity prices over the next maybe 6 months or year if that yield curve plays out. But that's going to be your opportunity to go in there and buy. Another thing I'd point out is look at the price of oil right now. Trading around $70 a barrel. It was under 66, 67. And that's with 2 wars going on. And that's with massive supply restrictions from OPEC plus. So if you take that out of the price of oil, we'd be trading at 40, 45, something like that. So that tells you that the global economy is very sick from a demand standpoint. I understand their supply increases, but a lot of that is demand driven, right? So that leads me to believe, along with a lot of the other things that I'm saying, that we could see a downturn in the economy, which would be negative for commodities overall. But again, like we were just saying, I think that's your time to step in and buy because you've got that asymmetry where the upside's a lot bigger than the downside. Gold is really interesting because if you believe that we're likely to have a recession, then you have to ask yourself, would we have a liquidity event? Because if we don't have a liquidity event like we had during the GFC, gold probably is still going to continue to trend higher, right? Again, with that volatility, it never goes up in a straight line. But if you have a liquidity event like we had during the GFC or the beginning of COVID, that's usually when gold sells off because ironically, it's doing its job because that's the only thing that has a bid. And these big hedge funds, they have to sell something to generate the cash. And the only thing that they can sell is gold. So they sell it, which makes the price drop. But again, if you look at the GFC, at the end of 2008, like we were talking about, or the beginning of COVID, when you saw that big price drop in gold, that was your opportunity.
George Gammon emphasizes the importance of understanding historical economic patterns, addressing government overspending, and preparing for potential recessions. He advises seeing short-term market dips as opportunities, especially in commodities and gold, while remaining cautious about volatility and long-term trends.